Hello, in this lecture we will continue on Chapter 8 talking about control of cash disbursement. So we're talking about cash going out, and in this case we're going to be talking about petty cash. Petty cash system of control, so this is going to be a small cash fund that we will then be using for small cash payments, and how can we safeguard that cash and put some controls over the petty cash fund. Small payments required in most companies for items such as postage, courier fees, repairs, and supplies could be coming out of the petty cash fund. Operating a petty cash fund. So first we need to put money into the petty cash fund. That's going to be the first thing that we will need to determine. We want to determine how much money do we need in the petty cash fund at any given time in order to cover these obligations that we believe that should be coming out of the petty cash fund. We are of course going to set a limit, an upper limit of how much money should be in the petty cash fund. We will safeguard the petty cash fund, put it in control of someone or in a safeguard or a safe or whatnot to have control over it. And if it's just, in this case, $75, what would we do? We would debit the petty cash, have another account called petty cash, and we would increase that petty cash. It's an asset. It's going to go up by debiting it, in this case, by $75. We're going to credit cash. What is cash? Really, in most businesses, that's our checking account. So we're going to credit the checking account, taking it out of the checking account. We're going to put it into the petty cash fund, actually taking that physical cash, putting it into a place that it can be then used in the future. Then, as transactions happen, people need money coming out of the petty cash fund. They're going to need to sign for the petty cash fund and tell us what the money is going for, and we can then keep a list and a record of that. So miscellaneous expenses, for example, we have the cleaning of the LCD panel and the tile cleaning adds up to $46, and we'll pay that out of the petty cash, and we'll create a list and the receipts in the petty cash fund so that we have that information. Merchandise inventories, so the transportation costs often might have to be paid through the petty cash. So we have that coming up to $15.05 in this case. Again, we might have the receipts in the petty cash fund, just a list of the payments. Then the delivery expense for a courier, $5. Office supplies here, $4.75. If we add up the outer column, we come up with the $71.70 in this case. So then we're going to make a journal entry in order to replenish the petty cash fund. So what we're going to do is we're going to write a check for the amount that was taken out in order to bring the petty cash fund up to the balance that we want to have in there. That balance being $75 in this case, being the account that we're going to have on hand. At the most we'll have on hand at any given time. And we will record the expenses in accordance to the receipts that we had. So expenses, remember, are debit balance accounts. They only go up, they go in one direction, bringing net income down. So we're going to increase the expenses by debiting miscellaneous expense, because we had miscellaneous expense, the merchandise inventory, for the freight of the inventory that we purchased, the delivery expense, and the office supplies. We're going to debit those accounts, increasing the expense amounts in them, decreasing net income. Then we're going to credit cash. Why are we crediting cash again? Because the cash is basically a check coming out of the checking account. So in this case, the cash, you'd probably want to think of it as the actual checking account that the money is coming out of in order to replenish the petty cash and bring it back up to balance of 75 in this case. Now, when we think about controls over cash, one of the major controls over the cash that we want to keep in mind is the bank account. The bank account is they're keeping their own books on our cash account. So by us using the bank itself is a huge safeguard over cash, and it does multiple things for us. One thing it does in particular is that it records all of our cash transactions in a separate location. So if we just compare our transactions to their transactions, we have a second record keeping, and we can see if there's any differences between the two, and therefore look for any types of problems. So they also have signature cards, so they can know who is responsible for the signature and who is required to do the signature, and verify that that is the correct signature for signing checks and dealing with banking transactions. Deposit tickets. When we make the deposits, we want to have that deposit ticket to record the deposits within the bank. The bank statement, of course, being one of the crucial things that we will have. A lot of times now we have the electronic banking, so we can see the deposits in real time, but many times many companies still basically do a bank reconciliation monthly or so, and therefore you need some kind of banking record to compare to our records and see the difference. That is one of the most important things, whether you're a large company or a small company. Again, this is one that applies, an internal control that applies to basically any size of company. Get the bank statement, reconcile the bank account to our records. Electronic transfer funds. We can have electronically transferred funds, of course, which is a service of the bank. There may be limits in terms of how much can be transferred and whatnot within that transferring process. Checks, obviously the bank provides the checks. The checks are a crucial safeguard for us. They're going to be pre-numbered types of checks, and that gives us a safeguard to see that if the number has been taken, if the numbers are not in order through our system, then that would be an indication that something is wrong. Obviously, the bank account itself is going to be a huge advantage to us. So the idea of putting the money into the bank is a huge advantage for us in multiple different ways. It does more than just store the money for us. It helps us to basically safeguard the money, as well as helps us to perform our bookkeeping and double check our bookkeeping through the fact that the bank has its own separate system recording our transactions. And all we have to do is then compare those two, that being one of the most critical things, that being a bank reconciliation, which is used by comparing the bank statement to our records. So the bank statement will look something like this. Now, of course, the bank statement is coming from the bank. So note the bank is kind of an independent third party reporting our transactions. If we were to get audited or something like that, you note that the document that the auditor often wants is the bank statement. Why? Because it's not generated by the company. It's generated by somebody else who is an independent person and therefore doesn't have any reason to not report correctly the information. On a bank statement, we've got the previous balance here. We've got the total checks and debits. We have the deposits and credits. So the total of the amounts going in, the total of the amounts going out, and the new balance here. So then what we're going to basically do is compare that to our records. And often what we'll do is we'll do a bank reconciliation, which we'll perform shortly, and just tick and tie out every transaction that is one in the bank statement and compare it and see if we have recorded the same transaction on our ends. And we should have all the transactions in there except for timing differences. So often the difference between the bank statement and our statement is going to be a timing difference. For example, when we write a check, we write the check and we record it at the time it was written. But the check has to go to somebody else, and they have to then cash it in their bank, and their bank has to then talk to our bank before it clears the bank. So the idea of the bank reconciliation is to tie everything out except for the timing differences. And if we can then do that, then we can verify that our statement is tied out to the bank statement. We have two separate set of books that are saying the same thing, and that would be an indication that everything is done correctly. And that is one of our major internal controls.